My favorite perks about real estate investing, and definitely one of the really trendy ones, the ones that you guys seem to like when I post about, are the tax advantages. And it's not as simple or straightforward as your CPA may make it sound. There's a lot of ways you can manipulate a property's basis and depreciation and squeeze massive tax deductions out of a rental property so that you can offset your ordinary income. It's all about how you manipulate your property's basis, quote unquote. We'll talk about that in a second. Let's hop over to an example. This is the gem of a property we talked about in the last video, the home run off-market deal we got with a direct mailer. $475 for 2 sixplexes, this one and the one behind it, in Louisville, Kentucky, or Louisville, Kentucky, if that's how you're supposed to say it. And of course it's worth a whole lot more than $475. It's worth about double that, right? But we bought it for $475. So our tax basis is $475. That was the cost of the good purchased, right? And when we buy this property, $475,000, we're allowed to depreciate it. The IRS allows you to depreciate your property. What does that mean? Well, properties appreciate, right? And that is true. Even when they appreciate, you're still allowed to depreciate them. It's like this imaginary loss that the IRS gives you to incentivize real estate investors. And the way that they rationalize you being able to take this imaginary non-cash loss is they say you have to pay it all back if the property didn't really lose value when you sell it. That's called depreciation recapture. So if you buy this property for $500,000 and you write it all the way off down to $100,000 left, you depreciate $400,000, and then you turn around and sell it for $500,000, they're gonna say, wait a second, you said this is only worth $100,000, you just sold it for $5,000. Now you've got to pay taxes on that $400,000 difference. That's called a depreciation recapture. You can avoid that by doing something called a 1031 exchange when you sell, or never selling and refinancing until the day that you die. And when you die, you enjoy something called a stepped up basis. Basically, your kids get a reassessment of the property's basis to its current market value, so they no longer have to pay back all those depreciation tax benefits that mom or dad took when they owned the property for 30, 40, 50 years, right? So you do have to pay that back, but there's ways around that. But that's how the IRS justifies it. They go, this is a deferral, so we'll let you pretend your property loses value. The reason they do that is they look at this property, they go, hey, this $475,000 property, maybe $400,000 of it is attributed to the structures, right? You know, the bricks and the roofs and the windows and the appliances and the floors and the paint, all that different stuff, right? And the landscaping and the parking lots. And the other $75,000, that might be for the land. Right? And that $400,000 portion that's attributed to the structures, well, the structures deteriorate, right? And even if you spend money to fix things, you can still write those off on top of the depreciation. It doesn't make a lot of sense. But the $400,000 of this property's value that's attributed to the structure of the property, the IRS says, you know what, the lifespan of this is 27.5 years. So you can spread a tax deduction of $400,000 on this particular 12-unit building evenly over 27.5 years. The result that you get is $14,681.82 of depreciation that you could write off every year. Now that's pretty cool because you're netting, we're netting about $40,000 of cash flow on this property every year on the pro forma. We are spending it on upgrading this property at the moment. We've done a lot of upgrades in the last year, but if you're netting $40,000 in cash flow on this property, you get to write off $15,000 of money that you didn't really lose. It's not an expense, it's a non-cash loss. And the cool thing is, when you go show it to banks the year later, even though you deduct that from your income, the banks add depreciation back because they recognize that it's also a non-cash loss or a passive loss, right? So that's called straight line depreciation. That's when you take this property and you divide a structure portion of the value by 27.5 years and you write off that fraction of its value every single year and you get a nice tax benefit. This saves me about $7,300 in taxes because I have a lovely 50% tax rate. If you live in California, you might have a high tax rate as well, or an East Coast state or some other high tax state where you have to combine federal and state taxes. So this saves you a good bit of money, but it gets even deeper than that. This isn't the part that's like so sexy that makes people go, oh, buy real estate and you won't have to pay taxes ever, right? This is what I like to call, and I'm not political, but this is fun clickbait. I call this the Trumpy stuff. You know, this is how you get like the, wait a second, how are you worth $5 billion and you paid 70 cents in taxes, right? It's because of this. If you own a lot of real estate, you get to take advantage of something called accelerated depreciation if you want to. And what that does, the logic behind accelerated depreciation, this is called a cost segregation study, where you get an engineer or a software in this case, and I can plug you with that software if you need it. You get an engineer or a piece of software to say, well, this property is worth like 400K, right? And there's two of them. So here's the report from one of the two. And each one is worth about 198, the structure portion. Well, of that 198 each, or 400K total, not every different piece of this property has a 27.5-year lifespan. The IRS would allow you to get someone out there, or for you to self-assess and say, well, some of the property has a 5-year lifespan and some of it has a 15-year lifespan. You know, carpets don't last as long as roofs, and landscaping doesn't last as long as a window does, right? Or an HVAC system does. And parking lots have a shorter lifespan, and so does fencing, right? So all these different components of your property's improved value, the structure's value, have their own lifespan. And they also have a certain portion of the property's value that is attributed to them. So in this example, this cost segregation study that I got on one of these two sixplexes, and they're identical, right? So I just basically duplicated the study for both sixplexes. Says, well, $37,000 of the 200 for this building is attributed to 5-year equipment, and $13,900 is attributed to 15-year equipment, and the other 146 goes to 27.5-year equipment. Right? So what does that mean? Well, now you don't just divide the 198 by 27.5. You divide 146 by 27.5, and then you divide 13.9 by 15, and you divide 37.8 by 5. And what you get to do is have a higher number that you get to depreciate each year. Now this 14,681 using the straight line method might turn into 20, which is kind of exciting, but not super exciting. The really exciting part comes into play when you use something called bonus depreciation. Now there's something out there called the Tax Cuts and Jobs Act that initiated bonus depreciation for rental property as an incentive to real estate investors all the way through 2026. And it starts to phase out here in 2022. This is the last year where you get to claim 100% bonus depreciation. This isn't a tax course. The long and short is everything under a 20-year lifespan could be fully depreciated year one. What that means for each of these properties is each of these 200K structures of this 475K total purchase got me $51,000 of bonus depreciation per year. That means on the two properties, I got $103,000 of bonus depreciation. It saved me about, this building, purchasing it for $475, knocked $103,000 off my adjusted gross income. And that saves me about $51,000, $52,000 right off the top of my tax bill just for buying this property. Now, I get to do that because I'm a real estate professional. If you spend 750 hours per year or more, and more than 50% of your total working hours in certain qualified real estate trades, you can take all the leftover losses from your property. If your property is basically running in the red, you subtract all the depreciation from your rental income, there's like 80K of losses left. You could transfer those all to your other income sources if you're full-time in real estate, or if your spouse is full-time in real estate. If you're not full-time in real estate, what happens? Well, you have a limit. You can still transfer losses from your rental property if you make less than $100,000 a year, and the losses are limited to $25,000 that you get to transfer over. It's still something. If you're making 90 grand a year, right? Or 100, maybe you made 130, but you got some deductions, so you got under that 130 mark, right? If your modified adjusted gross income is less than 100,000 a year, then you could still take 25K in losses from your rental property, probably what you got from this cost segregation study and bonus depreciation, and subtract it from your income. And I know that's all very technical and taxy, and really this isn't a tax guide, but what I want you to know is that if you are a real estate professional, you can deduct major depreciation, non-cash losses from your property. If you're not, you can get all the way up to $25,000 in passive losses if you're not making too much money. And if you are making too much money or don't want to take all those deductions, you still get $15,000 a year. And the beautiful thing is, once again, the lenders don't see this as a real loss. They all add it back to your income. It's not like writing off, too many expenses, dinners with clients or something like that. Now you can't qualify for a loan. We've deducted hundreds of thousands of dollars of depreciation from our income every year, and it's always added back by the lender. We never have a problem qualifying. The lenders never question why we depreciate so much. It's beautiful. So that's probably the trendiest benefits to investing in real estate. I wouldn't say it's the biggest one, but it's definitely one of the most fun ones because it feels like you're kind of like winning one over on the government, even though these are their rules, because they're incentivizing you to own rental property, and they're incentivizing you through these benefits that mean you don't pay taxes on income you use to purchase real estate if you meet certain guidelines.